Well, welcome back to another edition of Down the Middle. I recently had the pleasure of interviewing Charlie Plosser. He was kind of my first former Fed insider, if you will, that I've been able to interview. But today we have with us Joseph Wang. I've been following him on Twitter at FedGuy12, saying to myself, who is this guy who understands the plumbing of the financial system so well? Well, it turns out that Mr. Wang is the author of Central Banking 101, which I highly recommend we all read, because the plumbing has become, the mechanics of the financial system have become so critical. He was for 5 years a senior trader on the open markets desk at the Federal Reserve Bank of New York, where he executed open market operations and studied the inner workings of the financial system. Prior to that, he worked at Standard & Poor's and practiced law. You've got all kinds of education going on here. You've got a BA from Northwestern, an MS from Oxford University, and a JD from Columbia Law School. We're both Columbia alma maters, and we both wrote books about the Fed. Here's Fed Up, an insider's take on why the Federal Reserve is bad for America. Your title's much kinder than mine. But tell me, what were these last 5 years like before you left in June of 2021?
Well, first of all, Daniel, I want to thank you for inviting me onto your show. I really love your show, and I loved your book too. It was just a great read, and I recommend it to anyone who wants to learn more about how the Fed is, especially about the people behind the Fed. And so I worked on the open markets desk for the last 5 years, and it was a really good learning experience. When you're on the open markets desk, you're kind of basically in one of the centers of the financial world. The open market desk is basically how the Fed's trading desk. And so it's the trading desk that conducts QE, and it's the trading desk that does all the market intelligence for the Fed. So you have connections, you have contacts throughout the financial world. You get to talk to primary dealers, the biggest hedge funds, mutual funds, money market funds, banks. So it's a really good learning experience. You can really get kind of a behind the curtain look as to what people are thinking and what's going on. And on top of that, of course, the Fed has just reams and reams of confidential data, just regulatory data, and just things that unless you work there, you wouldn't be able to see. So you can really put together a very good holistic view of what's going on in the financial system and also how the mechanics of it work. And so that's basically what I specialize in. I was on the money markets desk there. And so I basically studied the plumbing of the financial system. And it was an exciting time to be on. I mean, through the crisis, the repo crisis, and of course, the COVID pandemic panic.
Well, so I'll give you a tiny bit of background on how unorthodox it was to work for Richard Fisher. So he established his own markets desk at the Dallas Fed. So I did kind of before every FOMC, I would travel to New York, and it was so fascinating that being a Fed insider, it was akin to being a priest. It didn't matter who you were speaking to and in what capacity, whether they were on the buy side or the sell side, they would give you their confession. They would give you all the data and information and intelligence that you ever asked for just by virtue of you working at the Fed. Did you have that same sensation?
Absolutely, absolutely. And I know that you were ahead of everyone in calling what was happening in the residential real estate market back then. And so that was awesome. Being at the Fed, every person you talk to, they just assume that the competition is confidential. And like you said, it's like a priestly confession. So they'll tell you what they're thinking, what they're doing, and why. And it's really eye-opening because you get that perspective from basically all the major market players, and no one else has that, no one in the entire world. So it is a very privileged position.
So when I was at the Fed, I was really good friends with Zoltan Pozsar. And he and I have stayed in contact over the years. I'm curious, when Zoltan was at the Fed, there was a map of the financial system, and kind of in the middle of that, was the central clearing, was the repo market, basically. And years after that, he said that the map that was flat had turned into an atlas, and that the plumbing of the financial system had undergone serious changes in the aftermath of the great financial crisis, and the way it operated, and the players operating in it had also changed. And this is really dry, arcane stuff, but kind of at the highest level, why is it important to understand the inner workings of the financial system?
So the financial system is kind of like the plumbing, right? I mean, when it works, no one notices everything. You just assume it to work. But when it doesn't work, then things can really blow up. So at a very fundamental level, throughout the financial system, the way that these financial players work is they have short-term liabilities and longer-term assets, right? So they assume that they can always roll over their short-term liabilities, right? That's how a bank works in terms of deposit and let's say loan assets. That's how a dealer works in terms of repo loans and holding treasuries. That's how money market fund works in terms of having, let's say, money market fund shares and then let's say treasury bills on one side. And being able to roll those loans over every day is basically dependent upon the plumbing in the system, being able to have short-term loans that roll over every day. The second that doesn't work, then everything kind of breaks in a sense, because in order to meet, you're going to have to sell assets, for example, to repay your loans because you can't roll over them anymore. And when a lot of people do that, then asset prices start crashing, and then maybe more people have to sell assets, get margin calls, and so everything blows up. And that's kind of why it's really important to understand the plumbing, because it's kind of basically the whole system is based upon these short-term loans that that are assumed to work, and usually they always do. I mean, I think in September a couple of years ago that it did have some kind of problem, and during the financial crisis it did as well. But usually, though, it works fine. But when it doesn't, bad things happen.
Well, we can go all the way back to Bear Stearns. And
yeah,
that was your absolute classic textbook example. If you can explain kind of what happened at Bear Stearns, just as kind of a primer of what happens when you can't roll those funds over.
Right. So Bear Stearns was a big dealer back then, right? And they had, and not just Bear Stearns to begin with, and later Lehman as well. They were basically a dealer, and the dealers functioned by having longer-term assets and borrowing overnight in the repo market. At those times, it was treasuries and it was mortgage-related assets, right? So what would happen is that if you were a money market fund investor, you had a bunch of cash and you would invest it overnight, kind of like you and me putting money in a bank in a checking account, except that when you lend your money to a dealer, you're lending it on an overnight basis, and you get collateral as a security, right? Back then, that was mortgage-related assets. Now, the way that you make money as a dealer, well, there's a lot of ways, but one of them is that you could, for example, fund these assets in the overnight market, and then you wait for someone who wants to buy them, right? So you're holding inventory, or maybe you try to collect a little bit of that roll. For example, you could have let's say, slightly longer term asset yielding like 5%, and you keep borrowing at 2%. So earning that 2-3% coupon, 3% interest rate differential. And this all works as long as you can continue to get funded, as long as people continue to lend you money on a short-term basis. When people stop doing that, though, then, well, you borrowed all this money to buy these assets, and now you have to pay that money back then, right? So how do you do that? Well, then you have to sell your assets. And that works fine if the markets are liquid. But if markets are not liquid, then when you sell that asset, you lose a lot of money. And when you lose a lot of money, then people start panicking, and then more people don't want to lend you money. Then you have to sell even more assets. And what that happens, though, is that the entire financial market's kind of crater. Then everyone else is kind of having some problems on their asset side, and maybe they're getting margin calls, and maybe people don't want to lend them money anymore. So you kind of have this avalanche of selling that begets selling. That ultimately turns into a crash. And that's kind of what happened back then in Bear Stearns and with Lehman Brothers. People were not sure whether or not the dealers were solvent because they had some assets on their balance sheet that were, mortgage-related assets that people were worried about.
Yeah,
so,
we don't talk about counterparty risk anymore, but we sure did back then. I mean, it was a big deal back then. So talk a little bit about, if you will, Jay Powell's first year in office, his first day in office. For heaven's sake, the Dow Jones Industrials fell more than 1,000 points, and he said a lot of nothing. And then, his first congressional testimony, he said, it's not the not the Fed's job to backstop the stock market. And then we had Volmageddon, and then we had General Electric debt get downgraded, Halloween of that year. And then junk bond issuance froze for 41 days. All in the background, he was hoping that quantitative tightening was like watching paint dry. And all along in the background, he was hoping to get the Fed funds rate up to 3%. But something gave in the financial system that didn't allow him to achieve those goals. What was happening in the plumbing at that time that made it so increasingly difficult for any form of normalization?
Yeah, so I think Chair Powell was trying to hike rates, and I think he got all the way up to, let's say, fourth quarter of 2018, and then he was forecasting 2 more rate hikes in 2019, and I think the market just kind of had enough, and as you suggested, things kind of fell apart. And then I think the January of 2019, they kind of had to do a 180 and suddenly have to say, actually, guys, we're not going to hike rates anymore. We're going to cut rates. And so I think what's happening is that there's when you hike rates, many things happen in the financial system, and one of the things that is really important is that the value of your fixed income, particularly things that people think of as safe assets like treasuries, they decline in market value, right? And treasuries are kind of like a type of money in the financial system. And when as time goes on, as you see the debt to GDP kind of explode higher and higher, every rate hike has a kind of a disproportionate effect on the market value of all this debt. And so you have people, for example, who maybe they're investors and they have a 60-40 portfolio, and then they're seeing their treasuries portfolio kind of decline in value, then they have to sell to balance in equities and so forth. So in a sense, when you hike rates and the level of debt in the system is really high, you're kind of sucking out market value, you're kind of sucking out money out of the system. And when you have leveraged players in the market, and of course people are always leveraged, that has a nonlinear impact that kind of past a certain point can really tip things over. And I think that's what happened back in 2018, and will probably happen again if we try to hike rates, let's say, as aggressively as we did before. And it wasn't even that aggressive.
We'll get there. I promise we'll get there. I'm curious about your views about kind of the reaction function of the Fed, how it's become a reactionary institute, especially against the backdrop of the introduction more than a year ago now of average inflation targeting, the idea of letting inflation run hot. This was kind of a refutation, if you will, of the Taylor rule, of any disciplined approach, rules-based approach to central banking. How Jim Grant has always said that the Fed is both the arsonist and the firefighter. So should there be a different approach at a high level when it comes to monetary policy making that is more rules-based?
So, the Fed has an inflation targeting regime. I've always thought that was somewhat humorous, because I think one of the things that you can clearly see, not just looking at the Fed, but in Japan and the ECB, for example, is that central banks actually don't have the power to create inflation. I mean, they've been trying for a long time. They just don't do it. So in that sense, they're kind of in a hard position where they're tasked to do something they actually can't do to begin with. So that's one thing. But having a rules-based approach, I think there are benefits to it. The benefits, obviously, is that it's transparent and that people can react to it and plan according to it. And I think that's pretty important in markets, being able to actually have an understanding of what the Fed's reaction function is. Because if you don't understand it and the Fed does something that surprises the markets, you could have some, we could have some blowups, and that's not good. But the bad thing, of course, is the flexibility aspect. When you have rules, then maybe you have that acts as a constraint, and maybe you are bound to them to some extent. Now, looking at today, for example, we have an average inflation targeting rule, but then just independent of the Fed, outside of the box, you have this enormous fiscal stimulus that's pushing up inflation, right? So if you have a rigid, inflation targeting system, even if it's average and targeting inflation, and yet you have this fiscal authorities kind of are intent of inflating with this fiscal policy, then, it'll force you to kind of maybe hike rates more aggressively than you otherwise would, right? So, but if you didn't have that rule, then maybe you wouldn't have to do that. So I think having rules, there are good things and bad things to it. And the good thing about the average inflation framework, though, is that how you interpret averaging over what period of time gives you a lot of leeway to kind of, maybe wink a little bit.
I think we're doing a lot of winking right now with the whole idea of transitory versus persistent. So
absolutely. It's like moving the goalposts, right? But I actually kind of think, though, that, well, I like to think, though, that they understand that maybe it might not be transitory. But the thing about central bank communication, though, it's not really telling you what they think. It's trying to shape the narrative, right? A big part of Fed communication is trying to control inflation expectations or rate expectations in general. So one of the Fed's toolkits, right, post-crisis, is something called forward guidance. And they'll say that, you know what, we're not going to raise interest rates for the next few years. And that immediately has an impact on how the market perceives interest rates. And, maybe what they're doing right now isn't saying that inflation is, not high or just transitory. Maybe what they're doing is trying to calm people down so they won't go out and panic by everything, right? The messaging, I think, is important in terms of inflation. If you think back to, let's say, 1930s when Roosevelt became president, he wanted to inflate. He's telling everyone, I'm going to inflate and I'm going to devalue the dollar. And people saw that and they were like, he's going to inflate. I better go buy stuff right now. And inflation skyrocketed. Maybe they're doing the opposite right now. I'm telling you, inflation is okay. It's going to go away. So don't go out and panic buy. Or they could actually believe that it's transitory.
I'm happy you laughed after you said that. But so the Fed got into the business in a much bigger way than it traditionally had of buying Treasury inflation protected securities.
Yep.
And that particular position got to be very sizable. And I think the Fed was trying to do what you just acknowledged and people know is the impossible, is to create this idea that can create inflation. So my question is, at this point, given they would prefer that the inflation starts to temper down, why wouldn't they be selling off their positions in these Treasury inflation protected securities? First of all, can you explain what they are? Just in case somebody doesn't know.
So TIPS are basically they're securities whose principal adjusts with CPI. So in a sense that you're getting a real return rather than just a nominal return. And the way that TIPS trade is that people take the difference between, let's say, a 10-year nominal Treasury and a 10-year TIPS and take that difference in yield and just assume that's the market implied inflation rate, TIPS implied inflation rate. And as you alluded to, the Fed kind of bought a lot of TIPS in the past couple years, and that was pushing down the TIPS real yields pretty low, and that was making market implied inflation seem larger than I think what some people thought it should be. And there was some I think commentary that maybe the Fed is doing this to kind of make inflation look larger than it is.
I might have written something about that a few times.
I was on the desk back then, and there was actually some research by the BIS who just kind of came out, and the BIS is like a respectable authority that central bankers respect, and they're like, I think that TIPS implied inflation is wider than it ought to be because the Fed is buying all the TIPS. So I actually sent that around to all the Treasury colleagues, and as far as I know, there was not some kind of conspiracy to do that. It was just Fed being the Fed and bumbling around, but yeah, maybe there was some kind of maybe someone did think that way. I was not aware of it, but yeah, that did give the impression that inflation was I guess higher than it otherwise would be if the Fed was not buying so many TIPS.
So couldn't they, in theory, start to more aggressively temper back their position in that market?
They could, yeah. So the way that the Fed does QE is that they try to make it they try to make their purchases in proportion to the amount of treasuries outstanding. So for example, if 10% of the if 10% of the treasuries market were TIPS, 10% were 10 years, then they would try to partial out their QE purchases in that say. So 10% of purchases go to TIPS, 10% go to treasuries. But that's the theory, and sometimes maybe things get lost in the details.
Mhm.
Yeah.
If you were to look at, say, R squared, first of all, what
Yep.
is it? What do certain rules and models at this juncture tell us where, in terms of where the Fed funds rate should be?
Yeah, so I think people look at this in different ways, right? There's like the shadow funds rate, I guess, and things like that.
Right.
I'm myself, I'm not too big of a fan of these economic models, and that's part of the reason why I like Chair Powell. I mean, I remember when he first started, he's not an economist. He's like, yeah, these models are great, but they're kind of for reference only. So when you think about I think when you think about the economy, when I think about it at least, I think it's too complicated to be distilled into just a mathematical equation, and definitely too complicated to be distilled to just, for example, rates as an input. Like somehow you change the overnight rate a little bit and magically, something happens, you get growth and inflation. I think there's just a lot of things that feed into what determines inflation, what determines growth. So having some kind of, any kind of model that just kind of says, if you move the overnight Fed funds rate to something that would give you some kind of outcome, I think it won't work, and in fact, it hasn't worked for some time.
Right. Overly simplistic, basically.
Very overly simplistic, and yeah, it's just, I don't know, maybe it's because the only thing the Fed can control is the overnight interest rate market. So that's how they look at the world.
So you were on the front lines, and for whatever reason, things always seem to happen right on my birthday, September 17th. But you were on the front lines.
Oh yeah, you were. Okay, that's right around the repo event. Yeah,
2019. You were right there. Repo rates spiked. What on earth happened? What created that moment?
Yeah, I was on the desk that day. I was probably one of the first people there, and it was kind of an exciting day. So repo rates usually are not very volatile, right? They're supposed to basically be the same rate more or less every day. And just the week before, it was about 2%. And on that day, so in that I can't remember the exact day, but just that 2 weeks into September, I got to my desk. It was about 7 a.m. right when the repo market opened up, and like within 2 minutes before I had even booted up my computer, I got a call from a dealer, and he was telling me that, hey, are you seeing this on the screen? I've never seen anything like this. I think there's something wrong with the repo market. I'm like, okay, I better look into that. And so I was entering my Bloomberg password to go in, and then I got another call saying, hey, look at the repo market. Something strange is happening.
Mm-hmm.
So now I have to go look at it. And I just, as I hung up, 4 more people called. So the phones would ring off the hook. So repo rates back then, they basically doubled. So they were like 2% something out the previous session, and then they were like 5%. And throughout that day, they got as high as maybe 9%. Maybe a little bit higher. And that's not supposed to happen because, repo normally is a very stable market. And more importantly, as we discussed earlier, it's the plumbing of the system. You have basically $1 trillion worth of borrowing in the overnight repo market every day, and people expect that to be a very stable market. And if interest rates got too high, then they would have to delever. And, as we mentioned before, that creates just sell-offs, and that can snowball into some cascades. So it was really not good to see the repo market explode like that. So immediately I alerted everyone who could do something about this. And after a couple hours, eventually the Fed came in that day, and we started lending in the repo market again, which we haven't done since the financial crisis. And that was kind of a crazy time, because you don't expect the repo market to basically explode. And if you look at a chart of SOFR, and that's the rate you would look at, it looks like they just went vertical that day. What I think happened back then is that you just kind of had this, it was basically a squeeze in the repo market, in the sense that it just kind of ran out of money. So the way that the repo market works, it's a one-day loan, right? So people don't actually have a lot of visibility as to how much money is available. So every morning, the dealers just call their money fund contacts, their cash lenders, and be like, I want this much money, and so forth at this rate, and there's a negotiation. There's not a lot of visibility into how much money there is overall in the market available. And all throughout the year 2019, if you look at repo volumes, they were steadily climbing. There's more and more people borrowing in repo. I think a lot of it was basically the cash futures basis trade, where people tried to arb the spread between cash treasuries and futures. And so that was just a trade that became very, very popular. And there was like anything else, you keep growing, you keep borrowing and borrowing and borrowing, and that's all fine, except that one day you show up to the market and you need to borrow because you have this, let's say, 10-year treasury on your balance sheet that you're rolling over every day that you funded in repo, and there's just not enough money. And what do? But you got to pay at any price. And so that's what happened. And the reason why it ran out of money is that just because that there just wasn't enough so the lenders at that time were largely the commercial banks. And the commercial banks were lending their reserves in the market because they had a lot of extra reserves and because repo rates were above interest on reserves. So they were doing that. But the repo market,
I hate to interrupt, and God, they kill me on YouTube whenever I interrupt. But just to clarify, we're talking about an ecosystem of broker dealers, a finite.
Yes. The broker dealers are, yes. Broker dealers are the borrowers in the repo market. So how this works is that broker dealers borrow from cash lenders in the repo market. They borrow for two reasons. One is to fund their own book of securities. The other is to pass the money on to their hedge fund clients. So basically, it's like they're borrowing overnight and then lending for a 2-week term to, let's say, a hedge fund client who also wants to, who's also having a levered position in treasuries. So that's how this works. And so just, back to banking basics, you have repo loans which are rolled over overnight, kind of like a demand deposit, right, at a bank. And a bank has loan assets, but a repo dealer has treasuries that they bought on their balance sheet, or let's say a 2 to 3 month loan to a hedge fund client. So both are, at least in the short term, not super liquid. Well, the securities are, but you don't really want to sell that because your whole business is to make markets and securities.
Right.
And so once you lose the overnight funding, then you kind of have to do something, right? And so if it's just a disruption for 1 or 2 days, you can just really pay through the nose and pay that 5, 6, 7, 8, 9% overnight. That sounds like a lot, but you have to remember it's an overnight loan, so you have to divide that by 360. So if you divide it, 5% by 360, it gets to a very small number.
Sure.
But if that continues for a while, then you have to do something on your asset side. So you have to either actually sell some of your inventory securities so you won't have to borrow as much, or you have to maybe not be able to lend as much to your hedge fund clients. So that's the ecosystem for the dealers, for the borrowers. On the lender side, it's usually the money market funds, but at that point in time, it was actually the commercial banks. So one of the things that happened post QE is that the Fed massively increased the cash holdings of the commercial banks. And the commercial banks have all this cash sitting on their balance sheet that's earning interest on reserves. And interest on reserves is great, but it would be even better if you can earn a little bit higher than that, right? And if you invest in an overnight repo loan that's secured by Treasury securities, you get the same regulatory treatment as if you were just leaving it at the Fed. And so banks are basically, let's say, making a few extra basis points on these repo trades. And at that time, the Fed was also doing QT. And so even as it was, so when you're doing QT, the Fed is basically shrinking its balance sheet and taking reserves out of the system. So at that juncture in the repo market, the demand for repo borrowing was growing. So repo volumes are growing, but the cash lending side, the amount of cash available to lend to the repo market was shrinking because of QT. And so you just had to hit that moment where demand outgrew supply, and boom, people were paying at any price and everything exploded.
We also had currency in circulation rising at a very fast rate at the same time that negative interest rates in other parts of the world had foreign central banks parking money at the Fed as well, because their countries were in negative interest. So a good buddy of mine, George Goncalves, the way he described it was that, even as Powell was trying, to push through with quantitative tightening, there were two other factors that equated to the amount of liquidity that was being pulled out of the system via quantitative tightening at the same time, and he's raising interest rates. So there was more tightening going on than what even was in the Fed's control at the time, because of outside factors, because there were negative interest rates overseas, because people were piling into cash, physical cash.
Yeah, for sure. Definitely the physical cash holdings have just been skyrocketing over the past few years. Actually, incidentally, I think most of that is actually held abroad. It's basically how a lot of developing countries, or maybe people who are escaping the law, hold their wealth.
It's true. I mean, it's true, but it's also a reflection of anxiety, if you will.
Yes, absolutely, especially if you're in a developing country, for sure.
So the Fed steps in.
Yep.
On my birthday, the Fed steps in, and then the Fed has to continue to increase the size of we called it not QE at the time, because it was these were technical adjustments, we were told.
Yeah, so the Fed inside the Fed, they were a little bit confused as to what was going on, because they were telling everyone everything was going to be okay, and then this happened, and this is repo market blowing up. It's not supposed to happen. So they weren't really sure if it had something to do with quantitative tightening, as in not enough reserves in the system, or if it was something else, maybe just the repo dealer, there was a run in the repo market, which is kind of how I think about it. So they did two things. They started lending into the repo market through the open markets desk, and they started doing, buying Treasury bills, which is increasing level of reserves in the system. So they did both, just to be sure that this would not happen again. And yeah, that seemed to fix it. Repo rates, normalized and went back to sleep again, which was good. So that they started buying those Treasury bills, and those bills are actually still on their balance sheet too. It's strange that they still have them there.
Well,
rolled over, of course.
Yes, but it kind of felt like, as we were approaching the end of 2019, that the market was looking for something else. That 1 to 2 year paper wasn't exactly what the market had in mind. That maybe it was true QE that the market desired in the old-fashioned way, in a sense. I like to think of, or I tell people that towards the end of 2019, because things hadn't calmed down to a good enough extent, that the Fed needed a black swan. And I said it back then. And boy, did they get a black swan.
Yeah, that was very much a surprise, I think, to the Fed and to everyone. I mean, how many people heard about repo before that?
Right. So, we get this COVID, event, and before we move on, so maybe tie the last discussion into the standing repo facility that's just been established, and tie that back into the stress that was in the system in 2019, and what the standing repo facility can theoretically do in the future. Not that we're thinking about that right now, because we're on the opposite end of the spectrum, but just the same.
So in the repo market, the Fed has two facilities, well, three, but two main ones. But heading into 2019, and something we've had for a number of years, is the reverse repo facility, which the Fed stands to borrow in the repo market for basically unlimited amounts at a set rate. And that's to control repo rates so that they don't fall below a certain level.
Right.
More recently, they introduced something called a standing repo facility, which is the Fed lending into the repo market at basically unlimited quantities at a set rate. And the purpose of these two facilities on the bottom and on the top is to control repo rates so that they don't get out of the Fed's basically range. And in 2019, after the repo market blew up in 2019, the Fed has basically been active as a lender in the repo markets. So even though technically there was no standing repo facility, they've basically been actively lending every day in the repo markets. And especially after the COVID pandemic, every day at let's say 1:15 p.m. to 1:45, 1:30 to 1:45 p.m., the Fed is there willing to lend. And no one ever borrows because there's no need. But the Fed basically just codified that informal practice with the standard repo facility, such that these blowups can basically never happen again. Because if there was ever a time where the repo market was losing control, people can always go to the Fed and borrow unlimited quantities at the Fed's offering rate. So that's basically an extra rate control tool that they have, such that even if they were to go to massive quantitative tightening again and shrink the balance sheet to like a tiny number, the repo market wouldn't blow up, because you could always go to the Fed standard repo facility and borrow unlimited quantities from it. In a sense, it's kind of like a discount window, but instead of for the banks, it's for the dealers.
Mhm. So in theory, the Fed has one tool to make sure that they maintain the floor.
Yep.
That rates don't go into negative territory, and they have another tool that makes sure that rates don't go above a ceiling. So they can theoretically control the range at which overnight lending is done.
Overnight repo lending. Yeah, there's some talk that maybe, so right now the Fed's official policy rate is something called the Fed funds rate, with an overnight unsecured rate. They also have this new reference rate called SOFR, which is a repo rate. And there's some talk that maybe eventually one day the Fed will move from the Fed funds rate to SOFR as their policy rate. And if that's something they'll do, then they already have the tools to control it. So they can make sure it doesn't go too low with the reverse repo rate, repo facility, and it doesn't go too high with the standing repo facility, like you mentioned.
So post-pandemic, obviously, the dearth of reserves problem disappeared overnight with $3 trillion and counting of just, correct me if I'm wrong, weren't there days that I mean, what was the biggest day of QE at the very beginning?
Man, so March was just an amazing month in terms of QE. I think the Fed bought like $1 trillion in like 3 weeks. So just all the time there, it was just amazing. Like, I mean, that's just mind blowing, the numbers that of QE that was being done there. So yeah, that was just unlike anything that the Fed has ever done before.
And so in the background, there's obviously this massive fiscal stimulus, the CARES Act, and can you kind of explain what the Treasury General Account is? Because it ended up at $1.8 trillion at one point, and in large part, it's come back into the discussion because now it's being depleted.
Yes. So the Treasury General Account is basically the Fed's checking account at the Fed. So depending on who you are in the financial system, you hold different types of money. If you're like me and just normal retail people, you hold money in the form of a checking account at a bank. But if you are a bank, you actually hold your money at a checking account at the Fed. And the type of money you have is called reserves. The Treasury also has an account at the Fed. It's called the TGA, and that's where it keeps its spare cash, basically. Now, in 2020, there was all this talk going on that maybe the Congress would do additional stimulus and so forth, right? And so the Treasury wasn't actually sure as to whether or not there would be stimulus or how much money would be. So what it did, though, it's that it wanted to be ready. And so it borrowed a lot of money, issued a lot of Treasury bills, and took that money and deposited it at the Fed in its TGA account. And you saw that account just skyrocket to over $1 trillion, like you mentioned. It's the highest it's ever been. And so it was just kind of sitting there waiting to be spent, waiting for the stimulus to come. But I don't think the expected stimulus actually came. So yeah, that was not necessary, but no one knew at that time. But right now the TGA account is being emptied, and it's below 100 billion, I believe. So it's been dropped a lot. And the reason for that has to do with the debt ceiling. So the way, as we all know, the Treasury has, the US government has a limit as to how much debt it can hold, right? It can issue. And unless that debt ceiling is lifted, it can't issue any more debt. So in order to stay above the debt ceiling, the Treasury is basically paying down some of its bills using the TGA account. And that gives it more room to maintain its normal coupon issuance.
Mhm.
So I'll step back a little bit. So Treasury issues coupons, which are basically, let's say, longer term debt that mature 1 year or more, and they issue bills, which are shorter term debt that matures within 1 year. The way that Treasury likes to manage itself is that it wants to keep its coupon issuance pretty steady, and it wants to use bills to manage its day-to-day cash needs. So when there are emergency needs,
variable, a moving
exactly,
target.
yeah, exactly. So when there are sudden emergency needs for cash, like like during the pandemic, they issued a couple trillion in bills without changing coupon issuance very much. And that's what those are for. They can, but right now though, they want to keep their coupon issuance steady. So as they try to cut down on debt, they're cutting down on bills. And so they're paying down their bills with their TGA account. So that's kind of going down, down, down.
Yep.
But eventually when the debt ceiling is raised, then that will go back up as Treasury can resume more bill issuance.
Well, so on the other side of that, we continue to see massive growth in the size of the reverse repo facility as the Treasury general account balance was drawn down. So at some point, if it's overnight, and I've asked this question, I think I've even asked this question of you on Twitter, but at some point, if it's $1 trillion or 1.6 trillion, or heaven knows it might get up to $2 trillion by the end of December, at some point, if it's very large amounts, even though they're overnight, is it tantamount to tightening?
I don't think so. No, I don't think so. I think the way to think about this is just to think about it from an investor standpoint. So if you're an investor, right? So you can you put your money, you can put your money in a bank, or you can put your money in a money market fund, right? Just assume that. In that sense, though, that from your perspective, it doesn't really matter. Okay, so when a money market, though, the people invest in the RRP, right?
Mhm.
They are money market funds.
Right.
And so when they invest into the RRP, what they're doing to settle that transaction, so the banks have to lose reserves and send it to the Fed. So in that sense, the banking sector has less liquidity because it has to settle a transaction with the Fed. And so reserves leave the bank's reserve account and go to the Fed's RRP facility. So in that sense, it reduces the amount of liquidity held in the banking sector.
Mhm.
So that's from the perspective of the banks. But from the perspective of, let's say, investors, though, there's really no difference. And basically, instead of holding, I mean, basically, you still hold a money market fund share or you still hold a bank deposit. It doesn't really change anything from your perspective. But it could slightly reduce the amount of liquidity in the banking sector. But the thing is, though, banks actually like that. So one of the restrictions upon banks post-crisis is something called a leverage ratio and a supplementary leverage ratio. And that means a bank can only have so much, can only get so big. It sounds strange, but banks can actually, have too much assets, too much money. So when you do QE, you actually stuff the banks with so much liquidity that it pushes against the regulatory ratios so that they can't get any bigger.
Mhm.
And one of the ways that they can actually have some relief from this is if they push money out of their bank into, let's say, a money market fund, who then invests in the RRP and shrinks the overall bank's balance sheet. So it's actually a helpful thing for the financial system.
Let's take this one step further, because there have been some papers written, some white papers written. The G30 put a paper out recently that walked through many steps that the Fed could take to ensure that what happened in March of 2020 was never able to recur again. I'm sure you were there when in overnight trading in Asia, you couldn't trade the long bond. So it was a highly unusual circumstance, but the G30 has started to has not started to. The G30 came out with a paper endorsing the idea of something called swing pricing. And the idea of, we know that in March of 2020, that when the stock market would fall by a certain percentage point, that circuit breakers would kick in and trading would be halted. There's an idea that the Fed could actually come in and implement the same type of mechanism, but in the bond market itself. And I'm talking about the corporate bond market. What are your thoughts on that?
Yeah, that I don't, yeah, I'm not too sure. I haven't really thought about that. I think it's good to have a price for liquidity, but yeah, no, I'm not too sure about that.
Well,
Yeah,
then
no, I haven't thought about that much.
we're going to have to come back and talk about that then.
Okay.
But the same G30 paper also addressed the issue of the central clearing of treasuries.
Yes.
And the idea that that the broker-dealer community being as small of a cohort as it is, that universe be broadened out, and that treasuries are centrally cleared. Maybe you can walk me through what percentage of the market is cleared in the broker-dealer community, and what central clearing of treasuries would actually do. Because again, you know, you're talking about the Fed trying to, with its standing repo facility and its reverse repo facility, trying to make sure that it controls the ceiling and the floor in the repo market. This would be something that ensured liquidity in the entire treasury market.
Yeah, so the treasury market is, you know, broadly broken up into like an interdealer market where dealers trade with each other, and a dealer to client market where dealers trade with, let's say, an investment fund wants to buy a treasury, then they would call up their dealer and be like, hey, I would like to buy a 10-year on the run. Can you sell it to me? And they would give a quote. So the interdealer market is cleared, but the market for dealer to customer is not cleared. And what that means is, if you have a cleared market, then eventually at the end of the day, all the trades face the clearinghouse. So that helps you save on actually control counterparty risk, but it also allows you to net your transactions. So it allows you to save on balance sheet. So let's say, you know, if I owe the extended counterparty this much money and someone else, and it owes me the same amount of money, then that nets out, right? Otherwise, it'd have to be a gross transaction, and that takes up balance sheet. And one of the impetuses for central clearing is that there's a thought that back during March, that one of the reasons why there was trouble. So just to step back, so what happened during March was that the dealers basically were not able to make markets in treasury securities, and that was very strange, because usually we think of treasuries as the deepest, most liquid market in the world. You're supposed to be able to sell treasuries instantly, but back then that wasn't possible, and that was tremendously distressing, because treasuries are basically like a form of money in the financial system, and calling up your dealer and not being able to sell your treasuries is just like going to the bank and the bank telling you, sorry, you can't withdraw anything. So that is all sorts of distressing. And there are many reasons for why that didn't happen that happened back then. But one of the reasons people thought was perhaps the dealers did not have enough balance sheet space. So they basically, everyone was selling them securities and they were not able to hold anymore, so they couldn't make markets. And one of the ways that you can potentially give more balance sheet space to dealers, though, is if you had centrally cleared treasuries, because in the payments, then everyone would be facing the central clearinghouse, and that would give them more space under the regulations, so they can net their payments, and so they would have more space to hold more treasuries. And I think that's I mean, obviously having a central clearinghouse is good for managing risk, and it's good for saving balance sheet. So I think that's a really good thing. If whether or not would have helped back then, I don't know. One of the things that I think we've come to learn is that it's not so much that there was not enough balance sheet space, as to when there's a lot of volatility, you just kind of, dealers just don't want to make markets, because you could buy something, the price can move a lot, then you could end up losing money. So it's just kind of prudent risk management. So, you know, let's say you buy something for $7 and you want to sell it for $10, right? But if the price is fluctuating a lot, maybe you buy something for $7 and you can only sell it for $6 and you lose money. So I think when you have really volatile pricing, it's just more difficult to make markets, and maybe having central clearing would have helped then. But I think it was probably not the only thing that mattered.
Well, what would the implications be in terms of profitability for the primary dealer community if we were to have such a central clearing of treasuries?
Well, central clearing usually makes markets, I guess, more efficient. So that makes the spreads narrower, or maybe makes it less profitable. So at the same time, it also makes it less costly, right? And less risky. So but if you look at the overall trend in the markets, I mean, let's say interest rate swaps, for example, they're all centrally cleared now. So I think that's the trend towards all markets. And it's just, I think maybe it makes trades less profitable for banks and dealers, but overall it does make the financial system safer. So it's not necessarily a bad thing.
So I've got a question or two that's come in from Randy Woodward here.
I love Randy's.
Randy's amazing. He's a great client. So in your book, Central Banking 101, you referred to the central banking community as a surprisingly tight-knit group. You go on to describe how many of the central banks, European Central Bank, Bank of England, and especially the Bank of Japan, not only have regular meetings, but send staff to work on the New York Fed's trading desk for periods of time. How do you think that affects policy between central banks? And do you feel one has more influence over the others, or does it ebb and flow? But most importantly, do you think actions by one bank, namely the Bank of Japan, can predict where the other central banks will head if need be? Specifically, do you think the Fed will buy equity exchange traded funds if they feel it's necessary? That was a big question.
Yeah, Japan does seem to be the leader in central banking policy, right? They did QE in size before anyone did. They were buying all sorts of assets before anyone did. So I think one thing to keep in mind is that the central banking community, at least in the Western world, in the advanced countries, they all kind of have similar structures in their economy, similar, Western democratic framework. They also have people who went to the same schools, right? For example, Mario Draghi went to MIT, and as did many other very prominent Fed people. So they think of the world in a similar way. So that's part of the reason why there's kind of a policy convergence. Fed has these. So during the last pandemic, the Fed bought corporate debt, right? And maybe a little bit of junk, and not a lot. Overall, I think they bought maybe 12, 13 billion. And
it was very nominal.
It was nominal, but it worked wonders. People saw that, and I think the bond market went on fire. On fire.
Well, I mean, it was $10 trillion on February the 19th, outstanding. For whatever reason, I remember February the 19th, I saw an article that said the US bond market has just passed the 10 trillion milestone. Now it's pushing 11.5.
Yeah, everyone wants to buy what the Fed is buying, right? Can't lose. So that's what they thought. So I think if you ask someone 10 years ago whether or not the Fed would buy, junk bonds, it would be no, right? So
when I was inside the Fed, we had that debate, and the answer was absolutely not. We talked about municipal bonds. The answer was absolutely not. And there was a big old debate about even mortgage-backed securities back then. That was even seen as credit easing and trying to alleviate one particular sector of the economy, which is a no-no. Well, it was a no-no at the Fed.
So the Fed has done things that no one thought it could do before. And I think people would like to say that's not legal or something like that, but I don't actually think that's the right standard when you talk about government, because the government kind of makes the rules, and so there really is no law that binds them. They could always find a loophole in a way. In this case, they basically had Treasury put down equity, and then they basically lend to that. So they had a special investment vehicle, had Treasury put up equity as a first loss, and then lent to that special investment vehicle, and that special investment vehicle bought, let's say, credit assets. And so they could easily do the same for equities. And, I have no doubt that if the stock market crashed tremendously, that they would do something like that. It's just that the stock market is so systemically important. It's where basically the vast majority of people, put their retirement savings, and including people at the Fed, right? I'm sure many Fed officials wake up every day and log into their retirement account and look forward to that day when they can retire, and they don't like it when they wake up and see it down 20-30%. So there is some self-interest there, and that's involved. If you look across the advanced economies, like Randy mentioned, the Bank of Japan has been buying equities. Swiss National Bank as well buys a lot of U.S. equities, actually. So I think that we are very much firmly on the trend towards the Fed one day buying equities. Just maybe a crisis away.
Would that be the right thing to do? I mean, there was the Treasury Fed Accord of 1951 after World War II to divorce the Fed from the Treasury and make sure that the Fed was an independent, apolitical entity as required by the Federal Reserve Act of 1913.
So
I
think that's no, I think that's how it should be, and I think that it's good to have an independent central bank, but we don't always have an independent central bank. If you remember, I think I remember reading this quote by Richard Nixon back then when his chairman Arthur Burns was being nominated, and I remember him saying that or something to the extent that, I hope you do policy independently, but I hope that you independently come to the conclusion that my view is the best, or something like that.
Oh, yeah.
So I think central bank independence is something that varies throughout time, and maybe we are moving towards a world where we have less of that. I think it's not good that we have less of that. We should have more central bank independence. But I think one of the things that happens is that if you have a central bank that is very accommodative, then you kind of, well, in a sense, you have your inflation and your goals. You have to react to what the other side of the government is doing, what the fiscal policies are doing, and so that kind of constrains you a bit. So let's say that the fiscal government wants to do something that wants to stimulate the economy, and has a goal of just significantly raising wages and reducing unemployment. And one of the side effects of that is higher inflation. I think it's very difficult for a central bank to go against that and try to raise rates, and, for example, to reduce inflation, even though that might come at the cost of Congress's goal of just raising wages and reducing unemployment. So it's a difficult spot to be in, and in that case, I think that I think it's unrealistic.
You're very much speaking to where we are today.
I think it's
literally describing where we are at this. I mean, we're at this very moment.
It's would be unrealistic to expect that, I think, the Fed to buck the congressional intent. So maybe a stronger, more independent Fed would, but I don't know if that's where we are now.
So let's just say that, well, actually, on a fundamental level, let's just imagine a world in which there was no dual mandate to begin with. Can you explain, kind of as if I was a 5-year-old, why the employment mandate naturally conflicts with the inflation mandate?
Yeah, so I mean, so let's say where we are right now, we have high inflation. So usually people think of, so traditionally there's this thought of the Phillips curve, right? Where you have a relationship between employment and inflation. And so when you have high inflation, you usually have low unemployment, right? Because you have the economy heating, and so there's more jobs, wages go up, inflation goes higher, right? So high inflation and low unemployment. In the same way, if you have high unemployment, usually there's low inflation because there's a lot of slack in the economy, right? So there's not a lot of people with jobs, there's not a lot of demand, so inflation is low. So there's kind of this push and pull here, where if you want to have very low unemployment, usually that means there's a lot of inflation, because that means there's a lot of demand in the economy, right? And right now we're at a moment where we kind of have pretty high inflation and also pretty high unemployment. So we're at this juncture where the Fed kind of has to choose between these two mandates. If it was focusing on inflation, then it would raise rates, right? But if you raise rates, you have this trade-off where you kind of slow down the economy, and then your unemployment rate increases. If, for example, you wanted to focus on your mandate of employment, full employment, then you would want to run the economy hotter, or at least to the level where you thought full employment was. And so you would leave rates lower, encourage the economy to grow. And so what happens then is that inflation rises above your target while you try to achieve the unemployment target. So in the sense that these are in conflict, and it's very difficult to resolve them. And the Fed is at a juncture here where it has to choose what's more important, inflation or unemployment.
So that's one end of the philosophical spectrum, because I've always been I wrote it in my book. I've always been an advocate of getting rid of the employment mandate and leaving that to the private sector, which allows the Fed to be, in my view, much more independent in nature. So at the opposite end of that philosophical spectrum lies central bank digital currency. And I'm curious what your views are about the idea of kind of the eradication of cash, everybody having a checking account directly at the Federal Reserve. This is kind of Lacey Hunt's nuclear option of making the Fed's liabilities into legal tender. What are your thoughts on CBDC? Because it is a very hot topic right now.
When I first heard about CBDC for the US, I had no idea why we would need something like that. And, I was thinking that I was crazy when I heard Randall Quarles basically say something similar a couple of weeks ago. So when I think from my perspective, I keep money at a bank. It's insured by the FDIC. I'm never worried that it will disappear. When I make transactions, it's with my credit card. It's instant and digital, and it works very well for me. So
Sure.
I have no idea why I would use a CBDC. And if you talk about maybe banking the unbanked, well, in the US, you go around every corner, there's a bank that wants to give you a free checking account and a cup of coffee. I'm sure that the Fed would not be able to offer you the same services. So when I think about CBDC, I wasn't sure about what it was about until I began to see what was happening with the nomination of the controller of the currency, Rolva, right? So the Biden nominee actually wrote a paper about the controller of the currency is one of the nation's top bank regulatory posts.
Right.
And the nominee for that has written papers on CBDCs and banking. And her views are that the entire banking sector should be socialized. Everyone should have an account at the central bank, and the central bank should decide directly or indirectly who gets loans. And it's basically, Soviet system, basically, just, or actually indirectly Chinese system as well. Basically, the government decides, you keep all your money with the government, and the government decides who gets loans. It's the complete opposite of our free market system. So the only way that CBDCs make sense, I think, is in the context of that plan. And it does seem like that there's an effort to move towards that plan. So I hope that doesn't happen. I think that is not a good direction for our economy.
No.
But I don't think CBDCs make sense for us unless that's the banking model that some people want to move us to.
Well, I'm happy that you're pulling with me to fight this. and I really do think that this is at the very core of the discord between Lael Brainerd and Jay Powell, because if you think of an Omarosa Brainerd team, that would be the dream team for universal basic income, effectively, and implementing a CBDC. So we can hope.
So if you think about the pandemic, there was kind of a test for that, right? But this time it was done through the banking sector. So basically the Treasury passed out a whole bunch of checks to everyone, and the Fed funded it through its massive QE. So it was basically the basic income, but it was done through the banking sector. A CBDC would allow them to just kind of bypass this whole banking sector thing and just send money directly to people.
And boy, would we have inflation.
I think it's happening as we speak.
Well, that's big. I tell people that we've taken universal basic income on a test drive, and we've seen what the result is, and it's more inflation than we've seen in our lifetimes. So, so there's a lot of talk right now about policy errors. And before we get to where we are today and wind up our discussion, I'm curious, do you think Do you think Lehman was a policy error?
Yes, actually, I do. Because it kind of brought down the entire financial system, right? So
Okay.
if we say Lehman, I would have that right.
Okay,
I
so
think
it's a rhetorical question to you and me. That's good news, but there's still a lot of debate that surrounds it. So
no, it's good that, I mean, we should have saved Lehman because, I mean, that really destroyed the financial system. Lehman was too big to fail, and if we saved Lehman, there would not been no great financial crisis, and I think that would have saved a lot of destruction to the real economy and to the financial economy and to like a. So here, when I was a lawyer, actually, one of the cases I worked on was on the Lehman Brothers bankruptcy, and I worked at a firm that represented the unsecured creditors for the Lehman Brothers, and we would get letters just from ordinary people who would send, who were creditors, who put their money with Lehman, invest in Lehman, saying that I lost everything, please help me get my money back. So there were a lot of real people and who got hurt there, and that would not have happened if we saved Lehman.
I happen to wholeheartedly agree. Let's end this discussion and promise to come back and revisit all of these subjects with the question of what should the Fed do? What can the Fed do?
Honestly, I don't think the Fed can do. I think the Fed is trapped, and that's just so. This is how I think about it, right? So you have inflation that's driven because the fiscal authorities are giving people a lot of money, and there may be some supply constraints as well. If you raise rates, that's not actually going to work that well in the contemporary banking system. And there's some structural reasons for that, but one of them is that if you were to raise rates, it doesn't actually tampen down on demand because none of that feeds through to normal people. Usually what happens when you raise rates, it works in two ways. One is that it restricts the supply of credit by making it more expensive for a bank to make loans. So if a bank is borrowing in money markets to fund its loans, then when the Fed raises its interest rates, then the cost of funds increases, and then the bank is more reluctant to make loans because it's less profitable unless it marks up. What we're happening right now post QE is that the banking system is awash in deposits, and so there's not a lot of and the banks don't really use money market funding anyway. But from a regulation standpoint, it's too costly. So that's not going to increase the costs of funding for banks. And from another, so that channel won't work. The other channel is that it creates an opportunity cost for consumers. Whereas let's say money market rates are 1%, maybe I'm less inclined to spend that money. But by that same channel that I mentioned before, the bank is not going to raise the interest it's offering to its checking accounts because it has so many deposits in the banking system after QE. So even if the Fed raised interest rates by 100 or 200%, it's really not going to feed into the real economy through those two channels. So that's not going to work a lot. But what it will do, though, I think will severely damage financial assets. And that could end up creating some kind of cascade like we saw in 2018. And so you can't really fine tune this that much. It's either a little that does nothing or a lot that just kind of destroys the financial market. So it's a difficult place to be in. But if you also think of it from a political standpoint, I think the Fed is changing in its composition, and maybe we have a more left-leaning Fed chair, possibly. I don't know, and that they could just choose to run the economy hotter. Basically, between their two mandates, choose employment over inflation as being more important. But the Fed is I think it's in a hard spot right now. There's really no good solutions.
I happen to agree with you, and we're about to find out. What tapering feels like, and whether or not the market's just going to shrug it off or not.
It's going to be okay though, because one of the things that I think that people don't really realize is that the effect of tapering has to do with Treasury issuance as well, right? So if the Fed is buying 10 billion bonds a month, that effect is going to be different depending on whether Treasury is issuing 100 billion a month or just 1 billion a month, right? So even as the Fed tapers in the coming months, the Treasury will also cut issuance significantly.
Right.
So net on net, there's not going to be too much of additional supply into the market. Well, I mean, the decreasing in the tapering will not cause incremental supply because Treasury will be cutting it.
Cutting its issuance as well. Yeah.
Yes,
In fact,
exactly.
Exactly. November 3rd happens to be the same day that Treasury is supposed to make its refunding announcement. So,
exactly, and that's when we'll find out.
two things on one day. Okay. Well, we've covered a lot, and I know this is really difficult material for a lot of people to understand, and I can't thank you enough because you do the best job out there at putting it into as plain of English as anybody has, and that's something that's really important because, well, as long as the plumbing's working, it's fine. But if you're in a house when the plumbing's not working, you're getting out of the house. So I thank you so much for your time, and I look forward to visiting again.
My pleasure, Danielle. I really enjoy your show, and thank you for inviting me. Love to come back.
Thank you. Take care.
Thanks.
So that was super wonky, I know, but if you listened to what Joseph Wang had to say, when things do go wrong in the plumbing of the financial system, the ripple effects throughout the rest of the economy and the world economy, for that matter, are absolutely critical to understand. So if you have to go back and watch it twice, go for it. And I do hope that you enjoyed his views. If you want to see a different perspective from somebody who's also another expert in the financial plumbing of the system, check out the interview that I did a few months back with George Goncalves. And he also provides great perspective into this arcane world that, again, is so critically important for investors to understand. I do hope you enjoyed this episode. Subscribe to the channel if you have not yet, and I look forward to the next time. This is Danielle DiMartino Booth with Down the Middle.